This will be, as always, on all your favorite podcast platforms under that Lead Lag Live banner. Please, folks, rate, review that on Spotify and Apple. And with all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Ryan Sweet, chief U.S. economist at Oxford Economics. Ryan, introduce yourself to the audience. Who are you? How'd you get involved in the economy and economics, and what are you doing in Oxford?
So my interest in economics really started off with my first econ class in undergrad. My professor related the labor market to baseball, and I was a big baseball player. So right there, I got hooked. Then I went to grad school, and then I got my first job as a professional economist with Moody's Analytics, and I just couldn't get enough of economics. Doing economic modeling, forecasting, analysis. I really enjoyed forecasting high-frequency indicators like employment, inflation, housing. So, I've been a professional economist for almost 17 years now. And then recently I moved over to join Oxford Economics. We do a lot of economic modeling, forecasting, analysis, and some consulting. And I've been their U.S. chief economist. And everything's fantastic. It's a very collegial group. We pump out, I can't believe how much work we actually get done and generate for our clients.
Let's talk about economic modeling in this environment for a moment. You don't have too many instances in history to compare what's going on today to the past. How do you model an economy when you're in an environment which arguably nobody's really ever seen before?
You're right. It adds a lot of uncertainty to your economic forecast, but these models that we maintain here at Oxford, they're living, breathing models. So, no model's ever going to be perfect. So we always are revisiting, different blocks of the macro model to see if something's broken down, if a relationship is changing. And so far, fortunately, I don't think the pandemic and the subsequent recovery has caused a lot of structural changes in the U.S. economy. Now, of course, there are some structural changes. I'm the poster child for one of them, and that's this work from anywhere. So, I live right outside Philadelphia, but I can, the Oxford Economic main office in the U.S. is in New York City, but I'm able to work fully remote. That's affecting people's migration patterns. And you can see that in the regional economic data. And this is another aspect of economics that I love, is taking regional economic data to answer macroeconomic questions. And one big question right now is, how's this work from anywhere going to influence the labor market and migration patterns? And you can see people are moving from New York, or they're keeping their job in New York, but moving down to a lower cost area like Philadelphia. People are leaving California and going to Boise, Idaho, for example, which is one of the booming housing markets that are in the U.S. So to answer your question, it just adds another layer of uncertainty. But for the most part, our baseline forecast is for a mild recession to start in the third quarter. And the pandemic really hasn't changed the tea leaves and the indicators that we look to assess the risks of a recession. So we understand there's a lot of uncertainty, more uncertainty than usual in our baseline forecast, but overall, the models seem to still be working the way we would anticipate them.
Is a mild recession enough to get inflation back to a 2% average annualized rate? I mean, it seems to me that, I would keep going back to this point. If you're going to go back to the trend line of the average, you have to, go past the average, which might mean some period of deflation. So, but I don't personally see how you can have that unless you have something more severe than just sort of a mild recession. But correct if I'm wrong on that.
I think even mild recessions are very disinflationary, meaning that the rate of growth in inflation will moderate. I think we only need a mild recession because if you look at what's been driving inflation, a lot of it is supply shocks, and a lot of it last year was supply shocks. That's Russian invasions of Ukraine that drove up energy prices. It's the lingering effects of the pandemic and its effect on supply chains. So supply chain constrained components of the CPI were rising very, very quickly last year. And then rents. I don't think it's a supply shock, but it's a supply issue. We didn't build enough affordable homes, over the past 10, 15 years. And that also contributed to, the strong rental inflation that we've seen. The good news is that we're starting to see parts of the economy where prices were rising most quickly last year are weakening. So energy prices have come down a little bit. Food prices are moderated a little bit. They're still elevated, but they're showing signs of softening. And we know rents, looking at market-based rents, which lead the consumer price index for tenant rents, we know that's going to roll over in the second half of this year. So as we go into a recession, we're going to see a lot of disinflationary pressures on those areas where we've seen the largest run-ups in prices recently. So rents, for example, energy prices, and that should provide a lot of relief on the broader inflation front. But to your point, I think the risks, again, getting back to the uncertainty in the forecast, it took a pandemic to bring back inflation. So we might need a mild recession to wring out some of that inflation that we're seeing, particularly on the services side. So our inflation problems in the first half of this year is more demand driven than supply shocks. But we need those supply shocks to continue to ease and create a lot of goods disinflation to offset some of the service inflation we're going to see. So we're not going to get back to 2% this year, but by the end of next year, we should see inflation back down to the Fed's target.
Why is it that credit spreads have stayed so tight? I mean, if you're going to have a mild recession, right? I mean, you have to have some degree of default premium, right, in the bond market, especially in junk debt. Why is it that these spreads have stayed so tight?
That's the $1 million question. I've actually been looking into this fairly recently, and you're right. I've been puzzled by why the high yield corporate bond spread is not wider than it is, given all the uncertainty in the economic outlook. Markets expecting a recession, which would typically imply greater bond market volatility, equity market volatility, and credit risk. But we haven't seen that. Credit spreads are, up and down the corporate credit ladder are still pretty tight from, up the backdrop of what we're kind of staring at. I think there's a couple reasons, and feel free to push back or throw in any other three you may have. One of them is that the quality of the high yield corporate bond market is different today. It's a lot better quality than it was 10, 15, 20 years ago. And one that I can't quantify, but I think is also playing a role is moral hazard. So during the pandemic, the Fed, for the first time ever, got involved in the corporate bond market. And investors may be thinking, all right, if we have a mild recession, the Fed's going to get back involved in the corporate bond market, which I think is a flawed assumption because this recession will be mild, and we're not likely going to see the Fed go back down to the zero lower bound, restart these credit facilities, and they won't have to get involved in the corporate bond market. But those are kind of the two areas that I've been thinking about most. And also, volatility in the equity markets and the bond market is fairly benign given, all the tightening that we've seen over the last 12, 18 months in financial markets.
Yeah, I had not heard of that argument that part of that's a moral hazard dynamic, but I think that actually makes a lot of sense. And to your point, there's a direct link between volatility in equities and credit spreads widening. Right? If you overlay a VIX spike against OAS option adjusted credit spreads, you'll see a 1-for-1 relationship for the most part, and you haven't had a real credit spread blowout because you haven't had a real VIX spike. And I also have been thinking that part of this also might relate to where we are in the cycle, in the sense that, as I've done my own research on this, a lot of these, junk debt type of proxies are pretty heavily focused on, miners and commodity type plays, right? Very leveraged players like that. So to the extent that there's belief that there's a commodity cycle, not necessarily a super cycle, that's a tailwind just because of the components of these junk debt indices.
Yeah, I think that's a great point. And it's pretty easy to forecast, out of a few weeks, high yield corporate bond spreads. If you use just what you said, the VIX, and if you throw in energy prices, it does a pretty reasonable job of explaining the ebbs and flows in corporate high yield corporate bond spreads.
The thing I keep trying to hammer the last couple of months is that there does seem to be a refinancing risk that's coming, just given the sheer amount of loans that were taken out at very low rates. You've probably seen a lot of the same stats or done this work too, but there's a lot of rolling over of corporate debt next year into 2024. And if that creates sort of a risk for markets, the market's going to respond to it this year, not next year. Do you think there's sort of a refinancing credit crisis maybe lingering out there on this rollover into higher rates?
Well, what we've been through since the financial crisis, I don't like to use the word crisis too often. I do think there's a big refi boom coming, and that's going to put a lot of pressure on the bond market, or the corporate bond market. I think the good news is that with a mild recession, that means the Fed's going to be cutting interest rates. Long-term interest rates are going to be coming back down. Corporate borrowing costs will be declining. They're still going to be higher than they were pre-pandemic, but they're not going to be at the rates that we are currently out right now, because the Fed is going to be in the midst of a modest easing cycle, and that should help take some pressure off. But if I think there's any immediate concern, one thing I'm increasingly worried about is the liquidity conditions in the bond market, and I think that is something that we're keeping a very close eye on, because this mild recession could turn into something worse if we get, an upheaval in some part of financial markets. The treasury bond market liquidity there is a little bit concerning. I think the area I'm most concerned is about the leveraged loans, that segment of the market, because we don't have a lot of clarity into what's going on in the leveraged loan market. So that is something that could cause a mild recession to be a little bit worse if there's an issue in some part of the corporate bond market.
Which again, I think is what the Fed wants to some extent, right? I mean, if you're gonna try and create some kind of recession to be disinflationary, you need to have some. Not crisis is not quite the right word, but you need to have some real stress, at least to take some companies presumably out and cause layoffs and all this.
Yeah, the Fed wants parts of the market to bend but not break. And I think one reason why the Fed will continue to raise interest rates over the next 3 meetings is that on net, financial market conditions have eased since October. And that's the opposite of what the Fed wants, because the transmission mechanism between monetary policy and the economy mostly goes through financial market conditions. So with the net easing since October, that kind of goes against what the Fed needs them to do to help slow the economy, reduce job growth, which would then help return inflation over time to their target.
What was the driver of that easing? So, I mean, back then I was very loud on Twitter, being dramatic, saying, the end of the world is at hand. That's why meltup's about to take place. And I was saying that purely because the speed with which the bond market was selling off treasuries in particular, trading like junk stocks, right? That was sort of an end of the world scenario, and you can't bet that way, so you might as well bet on stocks. That was kind of my whole argument for why things would go higher, and I think it's largely kind of proven out to be true. But what happened in October that created a kind of better financial conditions? What was the driver of that?
Well, I think the market was starting to price in the peak in the Fed's tightening cycle. The Fed wasn't as hawkish as it should have been. And then we got a little bit of encouraging inflation data, but then that got unwound in January. So we've seen financial market conditions tighten a little bit, but they're still not as tight as the Fed would want them to be. I think a catalyst for a significant and sudden tightening in financial market conditions would be this looming debt ceiling battle that we're going to have. We've all seen this movie before. It's a terrible movie, but we know how it ends. But they're most likely going to wait until the 11th hour to suspend the debt ceiling. But there's going to be a lot of angst and uncertainty and volatility in markets leading up to that debt ceiling, because I was actually very encouraged or very confident that we wouldn't have a nasty debt ceiling fight until I was in DC recently. And I didn't even know what was going on, but it was during the State of the Union, so I watched it. And just the political backdrop sets us up for a nasty debt ceiling fight. As long as they suspend it and we don't breach the debt ceiling, the economic impact is very small. It's just what it might do to equity markets, corporate bond market, in the weeks leading up to that drop dead date of the debt ceiling.
But correct me if I'm wrong, I think the risk is that you end up having a 2011 repeat, which I'd argue is more because of the credit rating agency than the debt ceiling itself, right? I mean, the real breakdown happened in August of 2011 when S&P did that official downgrade from whatever AAA to AA plus. Do you envision a scenario where the credit rating agencies again kind of kick back in and start to question things? As I recall, I think it was Fitch in 2020 that quietly did a downgrade. It just never got any attention.
Right. Now, I don't think they're going to overreact to the debt ceiling. Again, they've seen this movie before. The government's always going to pay their bills. And, when you look at the economy's balance sheet, the only part of the balance sheet, so when I say the economy's balance sheet, I'm saying household balance sheets, which are in very good shape in aggregate. Non-financial corporate balance sheets are also in very good shape. State and local governments are flush with cash. The only part of the balance sheet that's a mess is the federal government, but that's not a macroeconomic event. Their interest payments as a share of GDP are still very manageable, even with interest rates rising. So I don't see there's a lot of stress that's going to be an issue for the federal government. It's just the debt ceiling is just it's a political lightning rod. And if I was president, I would get rid of it. I would just eliminate the debt ceiling. It doesn't rein in government spending. It's just a tool to use every couple of years to have a nasty debt ceiling fight. And we've looked at past instances. You're right. 2011 was an anomaly, and that's when we had the highest economic and financial market costs. Was that around that fight? But this one could be also around the time we have a government shutdown, and every week the federal government is partially shut down, reduces GDP by 1/10 of a percentage point. So there are economic costs. Just unless we breach it or they fail to suspend it, I think overall it's just going to be us doing this repeat of a bad movie.
Let's talk about how individual companies, clients of Oxford Economics are are approaching you for suggestions or advice, so first of all, what types of industries do you tend to advise to, and what are some of the sort of common concerns that different companies have?
We have a very, very diverse client base. It can range anything from commercial real estate companies to retailers to pharma to financial services to the government. I mean, it's very manufacturing. It's a very broad-based client base, a number of clients that we have. There should be no surprise. It's the key issue. Are we going for a recession? How high is the Fed going to raise interest rates? Is inflation actually going to moderate, or are we in a new inflation regime? What's going on with excess savings, and how is the consumer holding up? And what's going on with the job market? And so there's lots of questions. It's an interesting time to be an economist. But I do think this recession, and one thing that we've been telling clients is that no two recessions are identical. And some parts of the economy will perform better in this recession than they have in prior downturns. So one, for example, is multifamily. There's an enormous pipeline of units that are permitted but haven't been started yet. So that should provide a little bit of a floor under multifamily construction during this recession. Vehicle sales, which are very interest rate sensitive, typically, weaken during a recession. But there's a lot of pent up demand for vehicles because the pandemic caused the supply shortages for chips, and inventories of new and used vehicles are still very, very lean. So we could see more production of vehicles and more spending on vehicles in this next recession than we have in other ones.
So I named the Twitter space the Fed's Hobson's choice, given a tweet I saw, right? So first of all, just because I had to look that up myself, but I understand why you framed it that way. But first of all, what is the Hobson's choice, and why does it matter for the Fed?
Yeah, so Hobson's choice is picking the better of two bad outcomes. And the choice that the Fed is currently facing is a mild recession now to help wring out some of the inflation, because as we discussed, recessions are very disinflationary. Face the potential for stagflation down the road. And stagflation is the combination of high unemployment and high inflation. That's a central bank's worst nightmare because there's no clear policy response. You can raise interest rates to help reduce inflation, but then you're going to push the unemployment rate even higher. And then vice versa. You can cut interest rates to lower the unemployment rate, but then you're going to push inflation higher. Stagflation's, that plagued the economy in the late 1970s and early 1980s. And I think, listening to the Fed and hearing what they're saying, if you put their feet to the fire, they would opt for a mild recession over having to, at the risk of a stagflation scenario.
I do a lot of these conversations, and it seems to be like a foregone conclusion that we're in stagflation and we're going to be in it for a long time. It doesn't sound to me like you think that's the case at all. I understand the definition of stagflation, but everyone seems to be kind of repeating this line that we're in a stagflationary environment.
Yeah, when a lot of people believe we're in stagflation, we're not in stagflation. So just the definition of stagflation itself, we wouldn't meet that criteria now. Inflation's high, but the unemployment rate is below 3.5%. So we have a very, very tight labor market. So we don't necessarily have a stagflation scenario. I mean, one economist in their 70s and early 1980s created something called the misery index, which is just adding up the unemployment rate and year-over-year growth in the CPI. And that kind of was their gauge, because they called it the misery index, because what do consumers hate? Rising unemployment and high inflation. So if you look at that misery index, we're not anywhere near the stagflation scenario that plagued the economy in the 70s and 1980s. So I don't think we're headed towards one. I don't think we're in the midst of one. And another criteria for a stagflation scenario to take hold is that inflation expectations need to become unanchored. And I think that's one issue why we had stagflation in the 70s and 80s, is that the Fed didn't appreciate the importance of inflation expectations and keeping them anchored. They do now, and they've actually done a fairly good job of keeping, market-based measures of inflation expectations. So if you look at five-year forwards, or if you look at inflation swaps, they all kind of signal that, inflation expectations are, pretty much anchored.
So I've used that line before, Ryan. The Fed doesn't own the bond market. The bond market owns the Fed.
Yes.
I want you to lay out why people get the causation wrong in terms of the idea that the Fed raises rates or lowers rates and the bond market reacts. I mean, all the things that I've looked at and seen would suggest that the bond market is way, way ahead of the Fed.
And that's mostly because of the signaling channel through which monetary policy can affect financial market conditions. So markets are forward looking. So they're anticipating, okay, what's the economic outlook for GDP growth, the unemployment rate, what's the outlook for inflation? And that's affecting what their expectations are, which expectations feed into long-term rates. So usually how I like to do it is I break down the 10-year treasury yield into its three main components: the expected path of the real Fed funds rate, inflation expectations, and the term premium. And the term premium is just the extra compensation investors need to hold long-term rates versus short-term rates. So, the different expectations in the term premium component and the expected path of the real Fed funds rate, that can move when the Fed's signaling, okay, we might be at a peak in the tightening cycle, or there's more rate hikes coming, and markets are going to extrapolate and adjust their forecast based on what the Fed is basically communicating. So the bond market's going to move first, and then the Fed will respond, because there's long and variable lags between changes in monetary policy and when it affects the economy. But the bond market's reaction to the Fed is almost immediate.
Right. I think this is where, if there is going to be a refinancing stress come in, where the stock market itself could maybe get hit. Right. Everyone keeps using that narrative that a Fed pivot is bullish for equities, when factually it's not. Most,
Right.
the bulk of the drawdown happens after a pivot because the Fed is acting late and they're reacting to spreads, which at that point would have already widened.
Correct. Yeah, and the Fed's going to pivot most likely in June, but that doesn't mean that they're going to start easing right away. They most likely will wait longer before they ease ahead of this recession, because they want to be 100% confident that they've broken inflation and that inflation is going to head back to their 2% target. But if you look at the Fed's summary of economic projections, and we talked about uncertainty, if you look at the uncertainty in their forecast, it's much higher than normal when it comes to the path of not only the economy and the unemployment rate, but also inflation.
Let's talk about global economies for a bit. I don't know how much work you do looking at Japan and Europe, but any interesting dynamics there in terms of heightened risk or things that could actually be a positive. I had Louis Vincent Gov on one of these Twitter spaces a couple of days ago, and he kept on going back to this point that you're not going to have a recession because China is about to drive the entire global economy higher.
Right.
Talk us through some of your work on the international front.
Yeah. So getting back to your question before about what clients are asking, one that I forgot to mention is the China reopening and its impact. And we have a global model. So if you change the Chinese forecast for Chinese GDP, that will feed into almost every other country that's going to be affected by it. So when we shocked and try to gauge what the reopening of China would do for the U.S. economy, the impact is pretty small. We're talking tenths of a percentage point on GDP, nothing massive, nothing that warrants any change to our baseline forecast or our assumptions. The biggest risk of China reopening for the rest of the world is energy prices and commodity prices. If that reopening is much stronger than what we're anticipating, that could drive energy prices higher, and that has a much more of a negative spillover effect on the U.S. economy. So to give you a good rule of thumb, every penny increase in gasoline prices reduces consumer spending by $1 billion to $1.5 billion over a course of a year. So you can tell that as you drive by the gasoline pump, each penny increase the economic costs add up very, very quickly. So I'm more concerned about China's reopening and its impact on commodity and energy prices then I don't think the reopening is going to be enough to keep certain economies out of a recession. So Europe, before I move to Europe, one thing about this recession that's going to be different is that the rest of the world's going to go in first, and then the U.S. will go in. Typically, in the last several cycles that we've looked at, it's been the U.S. goes in and we pull everyone down with us. It's going to be a little bit different this time around. So Europe is very vulnerable. They fortunately, this summer or this winter was mild, so that you didn't get these big spikes in energy prices. But they're still very vulnerable. We still think they're going to fall into a recession sometime in the next 3 months. Shortly behind them will be the UK. And you could probably argue that Canada is already in a recession. But again, these recessions, except for Canada, are going to be mild because most of the economy's balance sheet is in very good shape. Household balance sheets across the globe, they have excess savings still in many countries. That's going to help limit the severity of the downturn. The one area that I'm most concerned about the consumers in Canada, mortgage debt is gone through the roof. They've been re-leveraging over the last 10 years, whereas in the US, consumers on net have been deleveraging. So Canada is very vulnerable to anything that could go wrong on the household balance sheet side.
Yeah, I've heard a number of people make that point on the adjustable mortgage side. There's a tremendous slowdown that could be coming just because of the way that mortgage market works.
Correct. They need to refi every couple of years or every 5 years, whereas in the U.S. we locked in a 30-year fixed mortgage rate. That's not ever change, and that's some of the work that we're doing now is kind of looking at how long and variable these lags in monetary policy are globally, but also in the U.S. and whether or not U.S. economies become less interest rate sensitive because households have deleveraged over the last 10 years. Non-financial corporate balance sheets, if you look at their leverage as a share of GDP, it's still relatively tame. So the example I kind of use is, all right, I have a sub 3% mortgage rate. So even though the Fed has raised interest rates by 450 basis points, my monthly payment has not changed one penny. And 91% of all mortgages are fixed rate mortgages now. So I think that's providing some buffer in, limiting the transmission mechanism between monetary policy, primarily interest rates, and the broader economy.
Yeah, reset the room for the remaining minute. Everybody, please make sure you follow Ryan Sweet on Twitter. And if you are interested in learning more about Oxford Economics, check out his company as well as website, the Oxford Economics website. I feel like we need to hit on Japan a bit.
Okay.
So there was a lot of concern that with the attempt at yield curve control, which you can argue was somewhat worked, given the way the yen behaved, that this was sort of the moment everyone has been talking about and waiting for, that Japan was about to blow up. Obviously, it didn't happen. Where are we with Japan and the BOJ's response to inflation and how they're trying to manage currency volatility?
Yeah, so there's a leadership change most recently at the Bank of Japan that really didn't affect our interest rate forecasts or expectations for inflation in Japan. So far, they've been doing a reasonably good job. I mean, most central banks are under a lot of pressure to tame inflation, whereas I think the concern with Japan is that as they exit this yield curve control, was it going to explode on them and then push financial market conditions to be significantly tighter than by extension, push the economy into a recession? But of all the countries that we've talked about, Japan is one that may be able to skirt and avoid a recession. They're going to need a little bit of luck, but so far things are holding up fairly well there.
In terms of other dynamics that you focus on, there's been a lot of noise being made around how ESG and kind of the focus on the green economy is that pendulum swinging the other way, for lack of a better way of saying it. Again, I know you're dealing with a lot of different clients, but I assume there's going to be some that are focused on ESG type mandates. Are there any interesting things from an economic perspective that are happening from a policy perspective that are maybe reversing some of that money flow into that type of a focus on sustainability, or is that still continuing?
It's still continuing, and there's a lot more push to invest in ESG. And one thing that I track, we were talking about the corporate bond market, but over the last 12, 24 months, the amount of corporate bond issuance tied to ESG had been growing very, very quickly. I haven't looked recently, but I think most likely with what's been going on with interest rates, it's likely cooled. But I think going forward, you're going to see continued investment in clean energy, and with the infrastructure bill, that's just kind of putting ESG into the limelight. So I don't get any sense talking to clients or looking at the data that we're reversing the progress that was, or the push for more ESG.
And speaking of things which are not reversing counter to the narrative that's out there, I am very skeptical of the idea that we're in a phase of deglobalization. I think a lot of people talk about it. I don't think in reality it happens for a lot of reasons. I'm curious if you think I'm off on that idea that the trend towards globalization might slow, but it's not going to reverse the way everyone seems to think.
Oh, I need you to come around talking to clients with me, because we're all on the same page. This whole idea of reshoring, I think, is being overdone. So the idea of reshoring is bringing manufacturing back from different parts of the world, including in China, and bring it back to the U.S. I agree that globalization may moderate, but I don't think we're going to go through a wave of deglobalization. One reason I'm skeptical about the reshoring is, and not to get into the weeds too much, but the BEA, the Bureau of Economic Analysis, puts out cost estimates of the capital stock for manufacturing, and it's pretty old. So manufacturers would have to be very confident that they need to reshore to invest in new equipment, new plants, because that's going to be a long-term investment. And also, unit labor costs are still not in our favor. So rather than maybe building a plant in China, they go to Costa Rica or Vietnam. They'll find other areas to do their manufacturing. We did look at, what are some likely candidates for reshoring. I think one would be biomeds, pharma, PPE, things like that, I think could be reshored. But this broader shift that we're going to bringing all the manufacturing jobs back to the U.S., I think is overdone.
Yeah, I mean, the idea never really fully made sense to me because you need to have everybody do it at the same time. Otherwise, it's all these companies looking to their competitors to see who does it first so that they can capture some added cost savings, because now in China, you're have to competing, these factories will have to compete even more for a smaller client base, right? So
Correct.
Yeah, it just seems like a strange concept. And then the reality is, companies want margin. I mean, all this sounds great in theory, but greed will overtake any desire for redundancy more than anything else, I think.
Exactly. Never underestimate the impact of greed.
How do you let's talk through just sitting in your from your side of things. Presumably you're doing scenario analysis, right? And you're assigning probabilities to best case scenarios, worst case scenarios, average scenarios. What are the extremes? What's sort of a best case scenario? What's a worst case scenario for the economy?
Yep. Yeah. So we do a lot of scenario work. We pull our clients, we survey them and ask them what's their, biggest risk, or what do they see as the biggest upside risk or downside risk. And then we create these alternative scenarios relative to the baseline, because our baseline forecast is just the forecast in the middle of the distribution. It's the most likely outcome, but there's a lot of uncertainty and there's all different ways that the economy can evolve. It can be better than we expect. Maybe we avoid a recession. I hope my forecast is wrong. I hope our forecast is wrong because I don't want a recession. I'm not rooting for a recession. An upside scenario would be where consumers hang in there much more than what we're anticipating. So right now we have $1.5 trillion in excess savings. And this excess savings is just the additional savings that people have in their checking accounts, under their mattress, maybe buried in the backyard, relative to pre-pandemic saving patterns. That $1.5 trillion is a lot of firepower. What we do is we break it down by income quintile. And you can see most of the excess savings are with high income households, and they're more likely going to treat that as wealth than cash. And therefore, a lot of that excess savings might not get back out into the economy over the next 12 or 18 months. If that assumption's wrong and they treat it like cash, then consumer spending will be a lot stronger than what we're anticipating over the next year. And then that would be enough to help us avoid a recession. So that's one upside scenario. A downside scenario is there's a crack somewhere in the economy's balance sheet that becomes more glaring as the economy starts to weaken. So household, for example, maybe they're under a little bit more stress than what the data is telling us. Corporate balance sheets could get stressed. We talked about leveraged loans. So that something could go wrong in the economy's balance sheet, and that would be a downside scenario. Because what we did is we went back to 1948 and identified every catalyst of each recession. And common catalysts are policy error, either fiscal or monetary, inventory swings, asset bubbles, of course, a pandemic. But we don't see any glaring bubbles. But there's the old adage, you don't see a bubble until it pops. And that's potential downside scenarios, that there's something off in some part of financial markets that we don't see.
Do you look at market-based valuations at all as part of economic forecasting? I mean, you can't necessarily create an investment strategy around price to earnings, right? But
right,
really, it is related to bubbles from that perspective.
Yeah, so I don't personally put a lot of time in forecasting price to earnings, but we have an asset allocation team that's one of their tasks. There is parts of Oxford that does it. The U.S. macro team, from my perspective, a lot of the inputs into the macro model, that's not one of them.
Gotcha. Okay. So speaking of that kind of macro model, are there throughout time, do variables, I have to assume that there's almost a degree of optimization, right? Some variables have more importance than others, depending upon what decade you're in or what cycle you're in.
Right.
How do you go about that process of figuring out what matters more? You only really know with hindsight, right? But I'm always curious in terms of how that sort of dynamic aspect of modeling and forecasting works.
You're exactly right that the importance of certain things ebb and flow. So, for example, consumer confidence doesn't really matter for real consumer spending unless you're at an inflection point, meaning a turning point in the business cycle. But what we do is forecast accuracy is very, very important to us. So we kind of dig through all the different parts of the model, see what's working right where our forecast accuracy was good, all right, and make sure everything's still buttoned up there. But then we also pay most attention to where our forecast was off. And then we go back and try to re-estimate the equations. Maybe they had, the coefficients needed updating, or we do a lot of work on making sure that we have the right inputs because these things do change over time. For example, forecasting consumer confidence, really all that matters normally is gas prices and stock prices. But sometimes when you have a very extended period of low gasoline prices, the stock market's much more important. And so that way we can kind of turn things on and off, but we're always revisiting to make sure that the forecast quality is the highest it can be. You always have to have a little bit of humility when you're forecasting the economy because things can deviate from what your expectations are. But that's why we lean on these models and are always trying to improve them and strengthen them. Yeah, three of us used to always give our recession odds, and I think I was always the highest or second highest. I would say since then, I think the recession odds have come down. It's roughly, at one point at the peak, I was saying 70% probability of a recession. I think we're closer down to 60, 65%. And I think we're at that point where we might be able to avoid a recession, but it's going to be telling in the next few months. If the data holds up, then the odds of a recession are going to keep coming down. Those are my subjective odds. But at Oxford, we have all different probability recession models, some that use economic data only, and we have ones that are based on just the yield curve, but also other financial market variables. And for the most part, they're all signaling, particularly the financial market variables, a very elevated probability of a recession. No, it wasn't. It wasn't all seasonal adjustment. I mean, there's maybe a little bit, juiced it a little bit. Because if you look at the non-seasonally adjusted data and just look at the difference for all Januaries, usually employment falls by about 2 million on net. I think we might be off a little bit, but I think it was 1.3 million. So there's a lot fewer layoffs. And that might be attributed to we didn't have as much hiring in retail leading up to the holiday shopping season. So when the holidays were over, they didn't have to cut as many workers. But I don't want to downplay that number completely because of seasonal adjustment factors. But I think that was one reason. It was also a very mild January in the US, and weather can really swing some of the economic data. And that's why you always want to take every report with a little bit of a grain of salt.
I'm curious, Ryan, just, you're in this every single day. This is your career. A lot of people are very skeptical of the economic profession. And you can argue for some of it is for good reason, right? We're all trying to deal with the unknowable tomorrow and forecasting, and you have to kind of take that into consideration. But where do you think people get the field of economic forecasting their impression wrong? What do people get right and wrong about the profession of being an economist?
Well, it's a very difficult thing to do is forecast accurately. But I think what they get wrong is I think we're not doing this on, we're not drawing lines. We have these complex econometric models that are time tested to kind of forecast. I think the skepticism about the econ profession really intensified around the financial crisis because not many people saw that coming. And then forecasting around the pandemic was extremely difficult because things were changing on almost an hour by hour basis. So I think that's why there's been a lot of skepticism around economics. But there's that saying, economists are around to make weathermen look good.
Which is funny because the weathermen are the best at predicting the future in their domain.
Yeah, exactly.
Yeah, no, I think that's an interesting point. What would cause you to change sort of in a very 180 type of way of forecasts, right? So the economy doesn't move super quickly, obviously, but when you think about probabilities, I have to assume that the volatility of probabilities changing is not that high. But is there anything that would make for a very dramatic shift in an outlook?
Yeah, I think it all gets back to this consumer and the labor market. If the labor market remains this tight and there's no indication that businesses are going to start cutting workers, it would be very difficult for the economy to contract. Because at least historically, the unemployment rate has never gone up by 50 basis points year over year without the economy falling into a recession. And the rationale behind that is when people start to see their friends or family members get laid off, they run for the bunker and they cut back on consumer spending. That leads to more layoffs. And we can see how this vicious cycle gets started. So I think over the next few months, if the labor market remains strong, consumers continue to spend, then there's the potential that we'd have to take a recession out of our forecast for this year. But we're very transparent with our clients. When we're thinking about making forecast changes, we always write research briefings ahead of time. That way they know it's coming, because they understand that there's uncertainty in their own forecast and there's uncertainty in our forecast, and we just got to see what the economic data is telling us. And when the facts change, you got to change your forecast.
On Twitter, they call that flip-flopping, apparently, which is a very funny thing to me. It's like, again, you're supposed to flip-flop. That's how dealing with it's like when you drive. If you're not flip-flopping, you're always on cruise control. It's like, let's see how well.
Exactly. And the last thing you want to do as an economist, we try not to make significant changes to our forecast, because when you get a lot of volatility in your economic forecast, that's going to affect our clients and what they need our forecast for. Then if we're adding in a recession and taking it out, that causes a lot of headaches for them. So we don't want to do that to them, unless we have to be very confident that either a recession is going to happen or not happen for us to change our baseline forecast. They're not as strong as the retail sales number would argue. I was surprised by that number, but again, weather played a role, but also we had the largest cost of living adjustment that went into effect in January in decades. So that gave consumers a little bit additional cash in their pocket, and I think they went out and spent it. Also, if you look up and down the income distribution, I share a very similar view of you. Low-income households are out of their excess savings. We are seeing the strongest wage growth in retail, leisure and hospitality, in younger workers, because that's where labor supply constraints are the most binding. Other parts don't have that big of an issue of labor supply conditions. And that's, again, another unique feature of this recession is most likely you're going to see businesses cutting hours much more aggressively than cutting workers. There's going to be more of you're going to see more layoffs among blue collar jobs than white collar jobs, because businesses are hoarding labor and they recognize how difficult it is to hire. Therefore, they're going to be reluctant to lay off these workers at the first sign of any weakening in the economy.
Everybody, again, please make sure you follow Ryan's tweets. Great conversation. Thank you, Ryan.